Hello everyone, this is Teacher Karen. Welcome to Business Finance class. Our lesson for today is the flow of funds within an organization and from the enterprise. Topics to be discussed: financial system, financial instruments, financial markets, financial institution. Financial financial system diagram. These are the solid lines. Uh, it's all about flow of funds, and then the dotted line, flow of securities. Okay, so from the suppliers of funds to financial markets, then from financial markets to users of funds, and then from users of funds we'll go to financial institution. And then from financial institution, we will go back to the suppliers of funds. And then financial institution and financial markets are connected, even in a flow of funds or flow of securities. Then after that, they go to the private placement from suppliers to users. And then for flow of securities, we have from suppliers of funds to financial institution, then from financial institution to users of funds, and then from users of funds we will go to financial markets, and then financial markets go back to suppliers of funds. Then the users of demands will go to the private placement to suppliers of funds. Okay, so for more information, we will discuss how transactions between suppliers and users of funds take place. How would they prove that there was a transaction so that the demander will be able to repay the supplier on time and at the right amount? As I discussed the diagram of the financial system, you can see how the flow of funds go and how the flow of securities go. The most important is they have a private placement. Due to increased need for security for the performance of obligation arising from these transactions, the transfers of funds from one party to another are made through financial instruments. Okay, what is financial instruments? Financial instruments. When a financial instrument is issued, it gives rise to a financial asset on one hand and a financial liability or equity instrument on the other hand. Cash. This is the examples for financial asset, also cash, an equity instrument of another equity, a contractual right to receive cash or another financial asset from another equity, a contractual right to exchange instruments with another equity under conditions that are potentially favorable. Examples, notes receivable. This is the example for note receivable. It's the same for promissory notes. Another one is loan receivable. So this is an example of loan receivable. Another one is investment in stocks. Another is investment in bonds. So financial asset uh, is like that. No, it is not only recognized the cash, but also the receivables and the investment. Financial assets, who are the holders? Suppliers of funds are the holders of financial assets. How about the financial liability? It is any liability that is contractual obligation to deliver cash or other financial instrument to another entity, to exchange financial instruments with another entity under conditions that are potentially unfavorable. Example for financial liability are notes payable. It is an example for promissory note. And then loans payable, bonds payable. So if you says liability, that's an obligation or payable. Equity instrument, it is any contract that evidences a residual interest in the assets of an entity after deducting all liabilities. Example, ordinary share capital. Ordinary shares owned by common shareholders of the company entitled by to voting rights, entitled to dividends and capital gains, incorporated with higher risk as will be settled after the preferred shares. So what is preferred share? Not entitled to voting rights, entitled to dividends and capital gains, incorporated with lower risk as will be settled before the preferred shares. So financial liabilities and equity instruments, when companies are in need of funding, they either sell debt securities or bonds or issue equity instruments. The proceeds from the sale of debt securities and issuance of bonds will be used to finance the company's plans. Who are the makers of financial liabilities and equity instruments? The users of funds are the makers of financial liabilities and equity instruments. Common example of debt and equity instruments. Treasury bonds and bills are sued by the Philippine government. These have usually low interest rates and have very low risk of default since the government assures that this will be paid. Corporate bonds are issued by publicly listed companies. It is usually have higher interest rather than treasury bonds. However, they are not risk free. If the company which issued the bonds goes bankrupt, the holder of the bonds will no longer receive any return from their investment, and even their principal investment can be wiped out. Equity instruments generally have varied returns based on performance of the issuing company. Returns from equity instruments come from either dividends or stock price appreciation. Okay, preferred stock has priority over a common stock in terms of claims over the assets of a company. This means that if a company were to be liquidated and its assets have to be distributed, no asset will be distributed to common stockholders unless all the claims of the preferred stockholders had been given. Dividend to preferred stockholders are usually in a fixed date. No cash dividends will be given to common stockholders unless all the dividends due to preferred stockholders are paid first. Holders of common stock, on the other hand, are the real owners of the company. If the company's growth is soaring, the common stockholders will benefit on the growth. Moreover, during the profitable period for which a company may decide to declare higher dividends, preferred stock will receive a fixed dividend rate, while common stockholders receive all the excess. Okay, we will discuss now about financial markets. Financial markets participants will be central banks, corporations, institutional traders, retail traders, brokers, market makers, and government. Okay, primary versus secondary markets. Primary year, company sells stocks to the public for the first time. This is done through a process known as initial public offering or IPO. While the secondary market, here investors and traders buy and sell stocks to each other, the company does not participate in this transaction. For example, we have here the company of a car, then the investors, the primary markets, buy a car or bought a car here in the company, and then it will call it primary market. And then if the first investors sell the car to another investors, that is secondary market. Then the company will no longer uh, care about it. Money versus capital markets. Money markets, commercial paper, treasury bills, certificate of deposit. And then capital market is all about stocks, bonds, and derivatives. Money market for short-term debt instrument, less than a year. Money market is typically a telephone or computer market rather than a physical building. Example for this is the treasury bills, commercial paper, bankers acceptance. While the capital market, it is for long-term securities, financial securities, more than a year. Sample bonds, common stocks, treasury bonds, loans, and financial leases. Financial markets, we have capital and money markets. Money markets related to short-term borrowings, lending, buying, selling, and securities with maturity of less than 1 year. While in capital market, we have deals with raising capital by means of shares, bonds, and other medium of long-term investment. And then under capital market, we have primary and secondary market. Then we will discuss about financial institutions. One of the financial institution is the commercial bank. Individual deposit funds, which use the deposited fund to provide commercial loans to firms and personal loans to individuals and purchase debt securities issued by firms or government agencies. We have also insurance companies. Individual purchase insurance like in property and casualty and health protection with insurance premiums. They have also business insurance. Payments and invest the proceeds in various securities until the funds are needed to pay off claims by a policy holder. Because they often own large blocks of a firm's stocks or bonds, they frequently attempt to influence the management of firm's performance and ultimately the performance of the securities they own. We have also mutual funds owned by investment companies, which enable small investors to enjoy the benefits of investing in a diversified portfolio of securities purchased on their behalf by professional investment managers. When mutual funds use money from investors to invest in newly issued debt or equity securities, they finance new investment by firms. Another one is pension funds. These are financial institutions that receive payments from employees and invest the proceeds on their behalf. It includes pension funds, investment banks, unit investment fund, and credit unions, among others. Okay, before I end, words of wisdom. Money does not dictate your lifestyle. It's what you do to get it and how you manage your finances that determines your lifestyle. By Wayne Chirisa. Okay, that's all. Thank you. God bless and stay safe. Until my next video, don't forget to like, share, and subscribe. Click the bell button to notify you.